Hello. How are you guys doing?
Hi, good. How are
Hey,
you?
doing well.
Good.
I'm gonna start writing some things on the whiteboards as you guys are showing up, and I'm gonna try to get these policies. I've had a really busy morning and haven't been able to prepare as much for this as I wanted to.
Computer audio.
Let's go policy. So, can you guys see what I'm writing?
Yes.
Okay. All right. Let's see. This one is one. So I've got three different policies with three different companies. I'm going to put them all on here. They're all so different, and people ask me who to use, and I can't really tell you who's the best, but the last one I did is one I'm most fond of, but usually the last one you did is the biggest one. Let's see. We may not have that many people show up, but we'll see. So, guys, I'm going to go ahead and get started. Hey, Brock, how you doing? I see some of you guys still showing up, so I'm going to go ahead and just take the time to write down some of these policies that I have. I'm going to be open and honest as much as I can, and show you guys face amounts, cash values, and how I'm using them, how I'm using the policy loans. The face amount is 634, and hopefully it can be read. And I'm sorry, I meant to be more prepared for this. 469, 1.86. I see Harper's on here. Some of you guys I haven't met before, and some of you I have. So what I'm doing is just right now I'm writing down some policies up here so that we can talk about them. I'm writing down some face values, cash values, and then I'm going to show my policy loans, and then talk about more about what I've done with them and how I use these to invest in things. Cash value,
Here.
and then you guys can ask questions as we go. And okay, 43. I'll call that 43. So 178. Okay, so I've got those on here just so we can all see them. So I hope you guys are doing well. Thanks for jumping on here. This all came out of a post that I did the other day, and people wanted to talk about this, so I just decided to do this and show my policies. So I've got three policies, but first of all, just talking about whole life. Probably my first run in with this stuff was about 10 years ago. I heard a local guy here in Knoxville, Tennessee, um, on the radio talking about how he had something different than the stock market. And I've always been forward thinking on this stuff. I was in self-directed IRAs 15 years ago when a lot of people didn't know about them. And I heard this on the radio and I thought, I got to check this out. So I got in, and what he was trying to show me was the banking concept. So I'm pretty sure I got this book from him. I did. I got this book from him about 10 or 11 years ago and started reading it. And I'm a pretty smart guy and thought some of the things resonated, but I kept hearing advice. At that time, I was still listening to Dave Ramsey and Susie Orman, trying to get out of some debt and get some things on track. And I was reading that book, and then I would listen to Dave Ramsey say, "Don't do whole life. It's a terrible investment." And he called it an investment, and it's not an investment. And I don't look at it like an investment, and nobody here should look at it as an investment. It's a place to stockpile cash. And so the way I funded that very first policy was I cashed out an IRA, and I think that IRA or 401k was about $70,000. And my intentions, and the man that was selling me the policy's intentions, were that I was going to fund, I think it was 25,000 a year for 4 years. And the way they set these up, you can usually go 25, and then 6 months later you can go another 25. But I literally chickened out, and I didn't cancel the policy, but I didn't follow through on fully funding the policy. So I did the first 25, and then the regular payment to that policy was, I think, right around $7,800 a year. And for the past 10 years, I've made that $7,800 payment to the policy, and it's grown. As you can see here, the cash value on that one is up to $88,000. And probably about 5 years ago, I opened up another one. The first one's in my name, and the second one's in my name as well. I got a better understanding of it, had a better teacher, and decided to do another policy. And actually, it was 4 years ago, because we did 4 years of 15,000 each, and we've not touched that one on policy loans. But you're doing the math in your head, and you're saying, well, can't you put 60 grand in there? Well, come this year, we'll probably get close to having access to all that money. So depending on how the policy is designed, you don't get all the access to it right away. We can talk about that as you ask questions. But this last policy I did is with Emeritus, and it's a much larger policy, and it's actually on my wife. I was able to fund that with $70,000, and I was immediately able to pull out a loan on that one this year. We've already paid that loan down to 29. But we funded it with 70. We had cash value of 43. I can't remember if we got all that 43, but we pulled it out, and then we started paying ourselves back on that one. So right now, the 3 policies I've got I've got access to $178,000 of cash value. Now the difference is if that 178 was sitting in a 401k, I'd have to pay penalties. I'd have to pay 10% penalties and taxes to get it out. And this is still taxable, but this is not an investment. This is just a vehicle, I guess you'd say, another vehicle to get you there. So right now, the types of things that we've used our policy loans for, I did a policy loan on my tractor, and I think I've already paid that off. The debt you see here that are in these policy loans is probably a vehicle we bought in the past year. I think a camper. And I've done some real estate deals that went in and out of this, and I'm getting ready to probably pull 75 to 100,000 out of this in order to do a real estate deal. That money will go in and then come right back out pretty quick, so it's different. But I could easily go into a deal that cash flowed and use the cash flow from the deal to pay the policy loan back. But you definitely do want to pay these policy loans back. The way I see paying these loans back, though, is I no longer contribute to 401ks or Roth IRAs. So when I make myself a loan, I'm not trying to get the cheapest loan possible. I'm actually trying to charge myself market rates or above market rates. So if I borrow 75 grand from this thing, in a sense, I'm going to buy, it's almost like a hard money loan to myself, and I'll probably charge myself 10 to 12% on that loan. So let's say I took out 100 grand. I know that deal will come back to me in about 6 months. So I'd probably pay myself 110 grand. And what that does, it goes in and buys more insurance, additional riders, increases my cash value. And every year that we pay our debt back, we actually get more access to more cash value. So that's what's crazy about that, is it keeps growing and growing, and it gets more efficient with time. So that's what we look to. So this one policy that's almost 10 years old, we still send them $7,800, and we look, and the cash value now is starting to rise 10, 12, and over the years we'll put in that 7,800, and it'll turn into 15. and we put in that 7,800 the next year, and it raises the cash value by 20. And so that's what happens as these policies get efficient, but it takes a while, and that's why it's hard to see it early on, and it's easy to doubt yourself and know that they're doing what they're supposed to do. So that's the exciting part about it, is sticking with it, seeing it grow. Let's see. So, and it's something that I really believe in. We do this and we're committed to it. We're going to buy more policies. We'll probably put policies on our kids, because this is a great way to pass wealth to your kids and give them something. If you read this book, there's an example in here that'll show you that if you put a $2,000 a year policy on a newborn, it gets insane by the time that person reaches the retirement age. And if they keep paying that $2,000 policy the rest of their life, it goes crazy. I'm just going to open it up to questions and let you guys ask away. I know y'all have to have some questions. Because I never really meant for this to be just a webinar, right?
Yeah. Hey, I'll start.
Yeah.
Thank you so much for doing this.
Yeah, well, you can tell it's not very organized, and I don't sell this stuff, so it's just me sharing it. So thank you for being on here.
Absolutely. Do you mind sharing the interest rates on the loans you've taken, and where does the interest go? Does it go back to the insurance company, or does it go back into your cash value?
Okay, so I'm the insurance company. When we sign that contract, they agree to, right now they agreed, one of them is 4.5%, and I think the other's 5%. So what they're doing, I'm putting the onus on them. I give them all this money, and they promise me a return of 4.5% to 5%. So they're going to charge me that interest when I take a policy loan. Technically, a lot of that money is going back to me anyway. They promised me that they're going to grow my money by 4.5%. So if they make me a policy loan, and just to clarify that, I'm not going back in and getting this money. All I'm doing is taking a loan against the money that's in there. So the coolest thing about these policies is once you put $1 in there, it's in there forever. It's in there, but you can always borrow its buddy or its shadow back out. All right. So that's how we do this. So yes, if I borrowed 100,000, I would owe 4.5% interest on that for the period of time it was out. But what I'm going to do is pay myself 12% in that example. And that extra 4,500 and then up to 12,000, whatever that is, 7.5 or so, is going in to buy more extra policy. It's going to raise my cash value, and I've got more money to borrow the next year.
Gotcha.
Now, a lot of people get hung up on that because they're like, we financed cars in this. Well, financing a car at the credit union, I could have gotten a rate of 1.5%, 2% in the past couple of years. But this is another way for me to put more money in my policy. So you can do vacations, you can go as small as you want. And some people, my first policy, it was small. You start out where you feel comfortable, and then you realize you don't even hardly have to find that money to fund them. You can borrow money from one policy to pay the premium on another policy. So you can actually do some crazy stuff there. You do probably need, and it's not, you don't have to have this, but you need some kind of a windfall to start these things usually. And that's usually liquidating a 401k or a Roth IRA. If you've got 50,000 in a Roth, I would say liquidate that Roth and start a policy and maybe put what you're comfortable putting, put 15 or 20. And if you can be disciplined, they'll let you backdate the policy. And 6 months later, you'll be able to shove another 20 in. So in 6 months time, you'll have 40 in there. Now here's the kicker, is you're probably going to be able to get to about 25,000 of that 40 if you wanted to do a policy loan, because they are inefficient in the first few years. They can be designed differently. There's the emeritus policy that I just did. The first year I put in 70, believe it or not, and we were able to access 43. Here shortly, we're going to put in the next 70, and we'll have immediate access to that. I'll be able to pull out 70. So it's designed differently, and I think that was done down in Birmingham, where some people went down there and talked to emeritus and said, this is what we want. There's a lot of guys that do the Nelson Nash, they're practitioners of this. And this is probably the first thing that came out on what we're talking about, Becoming Your Own Banker by Nelson Nash. There's dozens of books on this now. They call it different things, cash flow banking, But those guys actually got to design, I think Harper that's on here, he can probably speak to that. They were able to design that policy and get what they wanted in that. And it gets you more cash value faster.
Gotcha. If you were gonna do it with like your Roth IRA, you'd have to liquidate, right? You couldn't like change it to a
would.
self-directed and then go from there.
Well, let me tell you, I liquidated one this year thanks to COVID. I think I've got 3 years
Yeah.
to put it back, but I'm not putting it back. I might if I have the money to, but I don't think I'm putting that money back. The
It's
best,
worth it to pay the taxes.
yeah, on the Roth, you've already paid your taxes, or you put money
Oh.
in tax free, right? So
Yeah.
if you're talking about a traditional, you're going to have to pay those taxes to roll into a Roth. To me, it's worth it. I don't trust even all this GameStop stuff. Just shows me the whole thing's rigged, guys. And I think this is what the wealthy did before the 401k was invented. I mean, this is what how people were saving money way before, and it's a lot more efficient, easier to transfer wealth to your kids. You can borrow from this the last 10 years of your life, and when you pass, the policy's going to pay those loans off. I don't have to pay any of these loans ever off. I can die with these loans. My policy is not going to give my kids all the money. They're going to pay off the loans, then give my kids the rest. So they're very efficient ways to transfer wealth. They're private. The reason I've actually got these numbers is the other day I did my financial statement for a deal I'm doing. And if you'll notice, one of the first places on your financial statement is life insurance. Nobody ever talks about that. Dave Ramsey doesn't talk about why would they want to know, because that's where the wealthy that keep a financial statement, that's where they keep their wealth. And you look at, it's kind of cool to, I love SEC football. A few years ago last year when LSU won the national championship, they used a whole life policy to incentivize Ed Ogeron. That's how they paid him. And they put the policy on him, and the longer he stays, the more of it he gets. And then if anything were to happen to him, it probably goes to the university. So these things are used to incentivize high-level CEOs all the time.
Got one more question, then I'll let someone else take
Yeah.
over.
Yeah.
How does it affect do they show up like on your credit report and your ability to get other consumer debt or
Nope.
even a mortgage?
Nope. That $50,000 policy line I've got right now does not, doesn't show up anywhere.
Gotcha.
Now, on my financial statement, it makes me show that I've got those loans because they're not going to count the loans. But it's great. You can hide all your debt. If you do have consumer debt and you want to get it off your credit report, my credit report used to be what I thought was high, was like 750 or 725. It's over 800 because of all the debt we moved off, and now we're debt free in the eyes of most people. We're in debt, and I don't care to be in debt to myself, right?
Yeah.
And so we stroke our debt payments right now. We're probably paying back $1,500 to $2,000 a month on our policy loans. So in a year, I'm going to put $24,000 back in my policies, and guess what? I can borrow it out for the next big deal. So I can't wait for 5 years from now. I'm going to have cash values of, 5, 6, 700,000, and I'll be able to take advantage. Here's the thing about there's the thing about your 401k and accumulation. What if the deal of a lifetime came along and you had to find $250,000 to do it? What would you do? Some people would say, well, I go borrow it from other people, but that's hard to do. And you may not be able to convince them to loan it to you. I've got it in my 401k, but gosh, I'm going to take a 30% hit if I get it out of there. And that's not, you're going to lose it there. If you've got the cash value, within 3 days, you can have the money wired into your account probably quicker than that and take advantage of that deal. So the accumulation of money in a 401k, having $1 million 401k, that's not putting cash flow in your pocket. Now you have to marry this with smart thinking and investments, right? So if I do a policy and I don't ever bank with it, and that's the key, and that's the first few years of me doing this, I didn't understand that my behavior in using it as a bank is what makes it grow bigger than it's projected. So if you've ever seen a whole life projection, it's a big chart that shows you each year your cash value and what it is in the next year. None of that matters. It actually, that's true. If you don't bank with it, that's what'll happen. And they're pretty sharp on predicting that. But if I use it as my bank, I can double some of those monies and those eventual death benefits and different things. So,
Gotcha.
and this is just like picking your retirement. Let's say you want to have $1 million. you go get $1 million of life insurance. You kind of pick the number and then work your way backwards. So another thing is I'm 45 years old. When I was 20, when we were starting to have kids at 30, I bought a bunch of term life because now I've got a responsibility, right? Now, if you buy a 15-year term, 20, I think we bought 20-year term because Dave Ramsey said when those kids are out of the house, they're not our problem anymore. So I'm 30 years old. All that insurance is going to expire in 5 years and it's gone, right? And it wasn't expensive. You know, this is the cheapest time in the world to get term, and you probably should have additional term on top of what you've got here. But when it expires, how would you like to have an event, have something happen? You know, we lost a 51-year-old friend last week here in Knoxville. And my first questions were, I hope he had life insurance and I hope it didn't expire when he bought it at 30. And here, and you know, his kids are still in high school. So hopefully they did the math, but that's sickening to think that somebody might've passed right after their term expired. The coolest thing is somebody's getting a lot of money when I die, and I'm going to use it before I die. And I don't want to, and I can control, I'm not going to use it to spoil my kids or make my kids millionaires and not ever have to work. I'm going to make them have to do things to access that money and learn what we're doing and how grandpa set up a bank for the family. All right.
Awesome.
Remember that always.
Anybody else?
Kent, Muthu here. Thanks for doing this.
Yeah.
This is first time I'm hearing this. I thought I was savvy, probably not. So, you know, and sorry if some of these are very basic questions.
Yeah,
And
that's okay.
you know, I'm not that familiar with whole life, to be frank.
Mhm.
So, I mean, I'm just thinking: is it after tax, or is it you know, the money that you put into the whole life? Is it after tax, or can it be before tax?
No, it can't. It's not a government sponsored vehicle, so it is after tax. So
Okay.
I have to pay taxes. And just realize too, I haven't said this, but there are a lot of bad whole life policies out there. And Dave Ramsey, those are the ones Dave Ramsey's talking about. So it's not just this is high cash value. It's well strategically designed whole life. So don't go out there and just buy a whole life policy today. You got to talk to somebody that knows what they're doing. And a lot of these guys know exactly what they're doing and how to design them correctly.
Do you have any recommendations?
I do. Some of them are actually on this call, and
Okay.
I didn't come on here they came on here to support me, I think, and they're good friends, and I'll definitely give you some names, and you need to shop around. Like I said, I've got 3 policies through 3 different guys.
Okay.
You don't have to do it like that, but that's how I've done it over the 9-10 years I've been doing this, and I can definitely put you in touch with somebody that can teach you. And the best ones are the teachers that'll it took me years to understand this and then doubt myself and listen to people telling me that I was stupid, I was wasting money. You have to have a good teacher that'll kind of hold your hand through this and look at you and say, you're doing the right thing. It's scary to liquidate a 401k, right? And put it into something like this. But once you've done this, you'll look back and say, I should have done more and I should have done it sooner.
Yeah, I mean, one option I could do is, you know, I could probably take a home equity, and then you know, put it towards the life insurance, the whole life.
Yeah, you could. I mean, that scares me a little bit, but I mean, you can fund these things any way you want. It's just as long as you got the income to support that home equity line. And obviously, you know, not everybody can come up with large sums of money to do this, but I do know a lot of people have money stuck in old 401ks, old Roth IRAs. That's a good place to get it. And then some people are in businesses. I mean, there's some unbelievable things you can do if you own a business. You can run your line of credits, your payroll line of credits through this. You can lease trucks from yourself at exorbitant rates, and all that money's going into your policy. There's so many cool things in this book. There's some cool stuff in here that tells you how to use it, and that's how it is. You need to bank with it in order for it to grow like you want it to.
Yeah, so the growth part is tax-free, I assume. For example, you know, let's say you you took a loan and 50K, let's assume,
Mhm.
and then it was an awesome deal. The next year you got 100K. Do you pay tax or on the, I mean, I would assume you would still pay tax.
You're going to pay your taxes because you're going to take a $50,000 loan from me. Let's say you go into a multifamily syndication and you need
Right.
50 grand to do the minimum on that syndication. You're going to borrow that 50 from your policy, and you're actually going to take create an amortization schedule on that 50. Okay. Well, you're going into this deal that's going to throw off, an 8 pref, and it's going to throw off a share of, but most of that's just pref, right? The first 5 years,
Right.
and they're going to liquidate it. So you're going to owe your policy a yearly payment around 4 to 5% of that 50 grand you
Mhm.
took out. So you're going to need to pay that. But let's say that the apartment building deal does well, and you strike this loan up and you say, I'm going to pay it 5%, and I'm also going to pay it 10 grand when it closes or whatever. So you could keep 20, let's say your 50 turns into, let's say any good multifamily deal should double your money in 5 years. That's my belief. So your
Yep.
50 should turn into 100. You can put all that 100 back in your policy, pay off the 50 original loan, and then the other 50 is additional paid up riders and goes into your policy. Or if you need to live off some of that, you could put 25 into the policy and live off 25 of that payoff. But you are going to incur your normal taxes. But hopefully, a good multifamily guy is going to give you some depreciation that'll help you there. But
Yeah.
this is tax-free growth, and when it's passed to your heirs, it's tax-free. But there's still the deals. All this is a place to keep cash. Okay, so it's just a place to store your cash. It's not an investment. And when your money's sitting in there, it's making 4.5% all the time. You're never taking your money out. You're taking out a loan that is collateralized by the policy. So it's always making 4.5%. So, and then if you,
Let me,
yeah,
sorry, 4.5% on the money left or including the loan? For example, it was 100K cash value and I took a 50K loan.
Mhm.
So is it making 4.5% on the, well,
you never took the money out. You took a loan for 50 that was collateralized. So the 100's still sitting in there making 4.5% every year in the policy, churning over. And the longer, right. So, but you're taking a loan and technically you owe it 4.5%, but let's just, there's a lot of technical stuff about that, but your money never comes out. So if you had a 401k, we talked a while ago about the deal of a lifetime, and you had 250K in a 401k, you would have to take it out of the 401k. It's no longer in the 401k making 6, 7, 8%. It's gone. So, but now you can go take advantage of the deal of a lifetime, which the 250 just got taxed down to 200 probably, and you don't have really to have the money, but we'll get past that too. So the shadow, I like to say that the shadow of your money's still there. The money's still there. You never took it out. You took a policy loan against it.
Does it provide some kind of asset protection? I want to pass it to others. Does it provide any kind of, like, let's say, something happened at my home and someone sues me, and instead of putting it in cash, does it provide, like, can they come after a creditor, come after me?
No, it's totally hidden from creditors from what I understand. So yeah. I mean, it's private. So it doesn't show up on my credit report. These loans don't show up anywhere. It's a private agreement between me and these companies. And it's wonderful in that sense. That's how, when I moved a lot of my debt off of my personal name onto this stuff, and I turned debt into a way of savings. Now, don't get me wrong. I quit funding 401ks, 10 or 15,000 a year. And now I'm happy to pay myself back in debt 10 or 15,000 a year. Right. So if you're like me, when my wife and I started out, it was hard to save money unless it was a bill, right? Or unless it was automatically deducted. So if you turn saving money into an obligation that I have to stroke a check for every month, I start to save money pretty well, because if I don't make that payment, I can honestly say in 20 years of doing life together, we've never missed a payment. I don't think we've ever even forgot. I mean, if we did, or we were late, we got it in. We just don't. We've never missed payments to anybody. Maybe that was Dave Ramsey and our building our credit that got into us early. But so if debt to myself becomes it's a payment to myself, that's easy for me to do.
Okay.
It's actually
yeah, I want to give the opportunity to others, but again, thanks a lot for doing this, at least opening my eyes.
Yeah.
I'd like to make a comment.
Yes.
You want to be sure that the company you're utilizing for the whole life is does not have direct recognition of loans. There are some excellent companies that, but they have direct recognition of loan. And if they do, then your dividend is reduced pretty significantly.
Hmm.
So you want to make sure that it's a non-direct recognition for a loan
I've
with
heard
the
that.
company that you're dealing
Thank you.
with.
Yep. It's wise to get good counsel like that before you just go out looking around. So I'm just looking at the chat right now. If you're borrowing collateral at 4.5 and your entire 100K is still growing at 4.5, you've basically created loan arbitrage using other people's money effectively at no cost. You're borrowing, yeah, you're arbitraging that money to yourself. So if I borrow at 4.5 and I charge myself 14.5, then I arbitrage 10%, and I'm happy to pay that to myself and not pay it to some bank. But really, the whole thing goes to me. There is some cost with the insurance policy, but that's the whole game, is arbitraging and buying more insurance with that.
Hey, Ken,
Yep.
one thing that I would add there is that you have a pool of money within your policy that is compounding uninterrupted, tax-free, and your policy loan against your cash value, right, like your line of credit from the insurance company, is going to be at simple interest. Then you're also going to have a diminishing policy loan that you're paying back every month or whatever your payback schedule is, and that's not even taking into account your higher interest rate you'd be charging, right? So you have a few different benefits there.
Yep. Tons of benefits.
Hey, Kent, Derek Gruning.
Hey, Derek.
Call. Thanks for connecting with me on LinkedIn and sharing a little bit about how you're using this in your development projects.
Yeah.
My question, my first one anyhow, is if you have, cash value and let's say 50,000 that you're able to take out in policy loans for year one, are you strategically trying to deplete as much of that policy loan so you're getting it out, using it in your other deals as quickly as possible, or are you trying to bank some of that so you get to that, say, 200,000 mark?
Yeah, that's a good question. I mean, we're paying back as much as we comfortably can, as quickly as we comfortably can. So I want to, like, we did a car in there recently, and you don't have to have real estate deals to do this. If you can move some of your consumer debt with your cars and silly toys into this, that's fine too. We did a 3-year payback. I mean, on a car, I think it was a $35,000 vehicle, and we're paying back about 40 payments of $1,000 a month. So that kind of tells you the interest that's going back in there. We're stroking it back as quick as we can, but not everybody may be able to afford that. But once you move debt, it's kind of like that debt snowball thing where you pay off a credit card, it frees up cash flow, right? So we've gotten to a point where we freed up so much cash flow that now we can pay back we can pay back $1,500, $2,000, $2,500 a month. And all that money we happily pay back is there to borrow a year later. It just increases our cash value. So it's really our own bank, and it's starting to really get momentum right now. But that's up to you, Derek. And you don't even have to make a payment. Let's say you borrow 50 grand, or let's say you hit a hard time. And I know the sad thing is, how many people hit a hard time in the last 12 months and they needed to have access to cash. And it was in their 401k, but because of some stupid penalties and stuff. And yes, there were relaxed rules with COVID, but they're afraid to access money that's their own money. If they had a policy like this, they could have took out 50 grand and made it through the year, no problem, pay it off whenever they want. They will probably have to send in a check for the 50 grand is going to probably cost them about $2,500 for the year. So they'll have to pay that interest at some point, probably on their yearly statement, but it was there when they needed it. And there's probably ways that they don't even have to pay that interest. The policy will start eating itself if you don't send payments. But if you hit hard times and can't do your payment, the policy doesn't just shut down. There's ways that the policy can live on. Maybe Harper could speak to that some. But did that,
Um,
that answer your question, Derek?
Yeah, that answers question number one. I'll let Harper respond and then maybe I can follow up with one more.
All right.
Yeah, sure. Can you recap that for me? I was munching on a little bit of food too. So
Yeah,
can you recap the question?
The question that I
real quick.
had, Harper, was is strategically speaking, is it best to try to deplete the amount that you have available in policy loans year after year, or might you try to bank some of that so that in 2 or 3 years down the road, you'd have more available in your policy loan to use on a bigger project or investment?
Preference, because while you're waiting for that deal, the beauty of it is like right now deals may be harder to find. So say you won't have a deal for 6 or 12 months, well, your cash will just be compounding within the policy. But if you have a deal and want to use it on a small project, great. If you want to save it up and use it on a bigger project, great. That's up to you. It's your call. You're the banker. You make the
are.
decision.
And the key, Derek, is to use it. I can't tell you how many friends I got into self-directed IRA stuff a couple years ago. They funded these IRAs and then they sit around waiting for the deal of a lifetime and it never comes. So if you have an IRA and you're not invested, it's not doing anything. So even if you have to pay off a $20,000 car and then over 40 months pay yourself back, I'm not going to say 500, I'm going to say 600 a month. Do that. You're banking. That's the whole thing. You want to be banking. I'm guilty of having 100 and how much was that? It was a crap load of cash value that I need to put to work. I've got 100. I can't even remember. 178 minus 56. I got 120,000 of cash value. It's growing, but man, if I banked with it, I could grow it faster.
Yeah. So like what I would say to kind of describe it is the life insurance contract is going to be the product or the platform, and it's going to have its own benefits itself, right? That we've been discussing. But the actual leveraging of that asset via policy loans is banking or infinite banking concept. Those are two separate things. So you got the product and you got the process, and the process is banking. So to really pull it together and make life insurance can be a great asset. It's a great vehicle. But if you use it correctly, it can be phenomenal to pair it with anything else you're doing, because you get both the policy and the cash value growing and those benefits, and you get your real estate investment or buying a car or whatever.
Great, thank you. Question number 2, and then I'll pass it on to somebody else. Kent, you had talked about how in some of your policy loans, in your real estate development business, you've kind of treated them as like a hard money loan. You're paying yourself 10 or 12% on that money.
Yep.
What are you doing with the cash flow from your real estate? Is that going back into the policy, and how might that affect hitting your MEC limit?
Well, this I come from a kind of a flipper rehabber background, so this is perfect for somebody that needs to buy a house and get the money to flip it or whatever. The deal that I'm doing right now, which is a tax credit deal, I had to fund this thing. I'm $178,000 into a deal that's going to require about $300. Now I'm going to get it all back probably in July. I'll get that whole $300 back. So instead of going out and begging for some line of credit or something, I've got that money there if I need it. And I'll probably do a kind of a hard money loan to myself on that and borrow out 100. And like I said, pay myself a 10%, 10 points on it. As long as I can show that that's kind of a market rate type transaction, I can do that. So that's a little different. If I had, I would probably pour the cash flow comes into my household anyway, and then we're paying back debts, and I would set up a comfortable payment back to the loan. So, but again, I'm in total control of every bit of that. I can, if I don't want to pay back so much this month, I don't have to, or if things got tighter, there's just no restrictions really on that. So it is kind of so overwhelming how many uses and ways you can borrow and pay yourself back. You can do hard money type length, or you can just do an amortization. I mean, I'll be within a few years, I might be within striking distance of the mortgage on my house. Then I got to ask the question, do I want to take out that mortgage on my house? And then now I've got freed up that payment, right? So there's tons of options. It's almost overwhelming, really. You can keep half of that cash flow and use the other half to pay off the loan, because all that does is frees up more money. The more you can pay off back to the loan, the more it raises your cash value. And, so you can still live within your means. I mean, we're not just blowing it out, but it's just a better place to save that money and keep it.
I guess I guess what I was trying to say was, if your base premium plus pay up additions, let's say, was capped at 50,000 a year.
Yeah, that's a MET question. Is that where you're going with that?
Yeah.
Okay.
And let's say in total cash flow, you might have been able to stow away a few 10 or 15,000 more.
Yeah.
If my understanding is you can't put that back into the policy unless it's under a policy loan.
Yeah, let's ask Harper, because you may be right, and there's some limits on that, but there's also some changes going down in that realm too.
So all else being equal, yes, you cannot, but that means that, think of yourself as a bank. When a bank starts being profitable and they have a lot of money flowing back to them, they're going to open up new banking branches, AKA open up more policies. So you would end up, if it can't fit in your policy and you have too much excess liquidity or cash flow coming back, then the obvious solution is to open up another policy and grow another policy to add to your portfolio.
Of course, that's the answer from a guy that sells policies. Come on.
Hey, I'm just being honest here. But you could also, you got to think of it, is your money's going to always be in motion too. So let's say you had 100K gross cash value, right? And net cash value. You take a policy loan for 50, and then you have 70 coming back from a real estate deal. Maybe you could fit another 10. You could put the 50 to pay off the loan. Then you could put another 10 in maybe. And then you still have another 10. It's like, I want to put it in there. Well, at that point, you may have already have something in the works to take out another 25 for something else. So your money's just going to be flowing in and out of there. So then it's like, well, that 10 could go to already pay off 10 of that 25 and so on and so forth. Does that make sense?
Yeah, it's a great problem to have, like, for both the salesman and the policy owner.
Yeah, there's also one more question too at the top of the chat. I think it was Alina. She asked to explain the tax-free. I believe she's talking about for the beneficiaries. So in most cases, those proceeds, the death benefit proceeds, will be sent income tax-free to your beneficiaries. Once again, in most cases, depending on situation. And the reason for that is, think about it this way. When you pay for your car insurance or house insurance and you get, if something happens, you're indemnified for the loss when the insurance pays out. It's the same thing. You're indemnified for that person's human life value. So it makes sense why it's not a taxable event, because it's replacing the income and their future earnings.
So if you total your car and they send you 20 grand, the government's not taxing the 20 grand to replace your car.
Yeah. But Brock, do you want to speak to that too? You can give a different perspective.
Yeah. So really, from my perspective, when you see these items, it's really got to be an importance on, it's going to be income tax free to your beneficiaries. However, we can run into an estate tax problem, right? So if I'm a real estate investor and I've 1031'd all of my properties for the life of me, and now I'm dead, and then it goes to my spouse or the heir that I left behind, it can, if stepped up in basis disappears, well, we can have the life insurance step in and pay for that. And something we don't want to forget is, in 2025, the Bush estate tax laws sunset, right? And so, whereas right now our estate tax limit is like $23 million, most people in America probably will not be paying estate taxes on $23 million, right? However, in 2025, if it doesn't get bumped up sooner, it'll come down to, I think the last time I heard it was like $1 million, or it's in the range of right in $1 million of estate tax. So if you have anything in your estate above $1 million, well, you'll be taxed on that. And then within the Biden and the Harris, what's the word I'm looking for? Administration, they are thinking about lowering that number even more and bringing it on even faster. So then it becomes an estate play of, okay, well, now my beneficiary may be a trust. That way, now I'm building an incentive trust for my kids that funds their life insurance policies. And then we become intergenerationally owning policies on each other that we can then use for our own selves. That was a long-winded answer, but hope I got it all.
I didn't realize those Bush tax cuts were expiring in a few years. It's not far away, huh?
It
Yeah,
is.
that's where I think with what Brock's describing there is you got a lot of different moving parts. So it's more than just the policy itself. You gotta think currently for your financing needs and the protection, but also longer term. There's a lot of things you gotta play into it too that can get pretty advanced.
Anybody else have any questions about how, and it's not rocket science. I mean, we've just, most people finance things. I mean, even if you have the cash to pay for it, doing this showed me that there's an opportunity cost with everything, every dollar you spend. So every time you pay cash for a car and you think you're doing a great thing and doing what Dave Ramsey said, that 25, 30, 40 grand that you paid for that car and struck a check for, it's sitting out there on 4 rubber tires. That's where your money's sitting. Is it doing anything? No. So why would you not borrow the 40 grand from your policy, pay yourself 8% or a lease rate or whatever you want to work out? And now that money is working still and you get the car as well. I love that part of it. And those are one of the things that just clicked for me. There is an opportunity cost to paying cash for things. So why would I ever pay cash? I'll borrow the money from myself before I would pay cash. And then you got to think about, is a free and clear house a great thing to have too? And that, there's all kinds of things that come with that. Security, you got to weigh that. My wife wants a free and clear house. I want a leveraged house because I want to have that money in real estate. So it's all personal preference. Yep. Anybody else?
Hey, Kent, one more question.
Yeah, sure.
You mentioned fully funding. Is there a difference between like fully funding it versus paying the premiums every year? Is there, like, if you fully fund it, are the premiums not due any longer, or am I way off base?
Fully funding it.
What do you mean by fully funded, fully funding the policy?
I'm not sure in what context you're
You want me
saying.
to take this?
Yeah, sure.
So very simply put, so you have, and when I mean simply put, I mean, I'm trying to break this down extremely, extremely simple for you. When you have this policy, you have the premium, and then you have the option of paid up edition. And so when you say fully, so there's a few different options. Okay. When you have fully paid up, that can be one of two things. One, you fully paid your premium within a given year, or there are some types of policies where when somebody says fully paid up, that means a policy may be paid completely up within 10 years and you don't ever have to put another dollar into it. Right. So you, in a policy, if the premium was, this is super hypothetical, but if the premium was $5,000 and you could put in an extra $5,000, the total you could put in a given year is $10,000, but the minimum requirement might just be $5,000.
Okay, thank you.
So a lot of these things are heavily funded in the beginning, and that's how every policy I've ever done was designed to be done. So, usually it's what I've seen a lot is 4 years of let's say 25,000, and then at the 5th year you're still going to have a premium, so you're still going to pay like 8 to 10,000, right? But you overfunded it in 4 years to get that money in there faster, and then from that point on, that 8,000 is going in. So that's kind of how my first one went. I chickened out and didn't fund the whole 25 the second year. I just paid the 8. That was the minimum to keep it going. Thought I'd made this huge mistake. Now I'm glad. I wish I had fully funded that one, but I didn't. But that's what these guys, Brock and Harper, do. They figure out exactly how much you've got, what's the best way to get it in there and get it back out to you efficiently, depending on your goals. If you're a real estate guy, you want cash value as fast as possible. You want that money flowing through the policy and back out in your hands as fast as possible. Any other questions? So you guys can tell that Brock and Harper kind of know what they're doing, and they are two guys that I would trust to do this. And I know they're also teachers at heart, and I'm sure those guys would love to talk to y'all about it. I didn't come on here. I didn't ask them to be on here to sell it or anything, but they can answer questions. I mean, I would tell you all, wake up. You know, if you've got money tied up in 401ks, I know if you're still working W-2 job, you can't get it out of there. But you can certainly fund it minimally. So if you have to get it, put money in there to get your match, get it. But I would not put 10 or 20% a year in a 401k and keep doing it. I don't trust the government with it anymore. I trust these life insurance companies that have been around 200 years and have paid dividends every year through the Great Depression, through the Great Recession, and all the way up to now.
What's the best way to get in touch with you guys, Harper and Brock, to discuss with you?
Why don't you guys put your contact in the chat, or go ahead and say it out loud and put it in the chat.
I'll throw it in the chat.
What are some other good resources that you guys have seen? I follow some people, and just kind of I'm trying to think of Garrett Gunderson's a guy that I kind of follow. And what would the
I would say Nelson Nash Institute YouTube channel, infinitebanking.org, and then I'm sure Brock has some stuff too. But if anyone reaches out, I'm happy to send any resources I have. And then, of course, I always have an offer on the table to send you a copy of Becoming Your Own Banker that he mentioned at the beginning. I'll send that to you for free. I just need your address.
Yeah, for me, if you follow me on LinkedIn at all, you know that I am a avid reader, and I have a massive list of books that'll tell you everything you could think of about these policies. Massive list of podcasts as well as videos, and always free to share that stuff with you guys.
Brock, you need to do your top 10 infinite banking books on LinkedIn. I'd be interested in seeing what they are.
All right, I might just have to do that.
Well, I'm willing to hang around till about 1 o'clock. I mean, I'm sorry this wasn't very structured, guys. I'm not a big presenter, but just wanted to get this out there and give a forum to talk about this stuff.
Your name and New York one.
Any surprises, Kent? Maybe I know, of course, you have great things to say, but anything that caught you off guard, or maybe a negative surprise that you had?
You can do that. Just go ahead.
Early on, negative surprise, not really. Honestly, it's the who sells you the policy. Do they have a heart of teaching you and helping you learn to use it right, or are they just trying to sell you a policy? The first guy definitely was in that ire. He sold me a policy, but he really wanted to get to a couple people I knew, a couple people that invested with me in real estate. He knew they had bigger net worths at the time, and I picked up on that, and I was just So then I went looking for another guy, or somebody else, and he's actually in Kansas. So it didn't matter where they were, and he was a great teacher too up front and helped me understand it better, but not much follow up on it. So that's your key, is you want somebody that'll help hold your hand and help you understand how to use it, and kind of make you do some things that, if you're going to do this right, you need to create little promissory notes to yourself and stay on top of that and know how much you owe yourself. I guess you could probably get audited, and you'd want to show that you're paying yourself back for a loan that you took from a policy, and that's where the money's going. So all that's important, to have somebody that'll do that stuff with you and help you out there.
Got it. How much is the administrative burden? Is it, taking the loan out, and is it easy to do, or
Yeah, there's
you
no
talked about
Yeah, there's no credit check or anything. So all they do is look at your value. Like the policy I got last year, I can tell you exactly. I got out. I looked at it a while ago. I'm not going to tell it. All they do is look at your cash value. If your cash value is 100, you may have some kind of limitation to whether you go early on, you only get a percentage of that or whatever. But each company's different. So most of them have an online thing where you go on there and you can request the maximum loan amount, and they send you a check for the last every penny that they can give you at that moment. It
okay.
shows. I mean, there's no credit check, because if you don't pay it back, they don't care. That they've got 100% collateral in their hands.
Got it.
Would be,
Do they, do you have to write a note to yourself, or you have an attorney, or is it like just take
No,
loan and then? Oh,
no.
you mentioned some promissory note. Was it just like more
Oh, simple. I mean, if you
concept?
just your own, get online and just Google a one-page promissory note to yourself. It's easy. You just set an interest rate, set a payment, figure out what your payment is, file that away, and just say that was the car loan that we did back in 2021. And just real simple. If you're in real estate, if you're doing fix and flips or anything, maybe you're passively investing. But to me, that wasn't much. But
I would, hey Kent.
Yeah.
I would add that when you are doing that stuff, if you are doing a lot of loans for investments and there is conversation about tax pieces, or there's just a regular flow of money, do consult with your accountant so they can keep up with that paperwork and money flow, because you don't want, a bad investment to happen and then you get audited and then they come in and say, oh, well, this, that, and this, we need you to show all this paperwork, and then you can't show it. Doesn't ever really happen, but you always want to cover your tracks, right?
Got it. Thank you.
Yep. But if you could borrow money and not do a promissory note, we did that. I mean, we just kind of paid it back. We didn't really have any documentation behind it early on. We just knew we took out 30 grand and we need to pay that back over a couple of years, and we did. So
Yeah. Do you have to show that, hey, you take money out and put it in a syndicate? Do you have to show that it went to, solving some debt problem, or you can do it for whatever you want?
do it for whatever you want. You can anything you want. It's your money, and it's not. I mean, you can go buy a car with it. You can pay off a note with it. You can go put it in a syndication. And you don't ever have to pay it back. I mean, if you don't, you're kind of hurting yourself. You're not being an honest banker. And when you read Becoming Your Own Banker, you'll understand that. But you don't even have to pay it back. And the thing is the year after that, you're going to have more money to borrow, and you don't have to pay that back either, but you need to.
Got it. Awesome. No, Ken, thanks a lot. And Brock and Harper, thank you.
Yeah.
And others.
Yep. I got a couple more minutes if you guys have anything else. Let's make sure we got all the questions answered in the chats. And if you guys think we're good. Well, I hope this was of value to you guys. And if you're sitting on the fence on whether to do this, I can just tell you there's two things I regret: that I didn't do bigger policies and I didn't do them earlier. The earlier, the younger you are, the better health you're in, and you'll qualify for better rates. And but the younger you are, probably the less money you have, and you can't afford as much. Get started with something. That's the key to this. And I don't think as long as you stick with it and have somebody that's really showing you how to do it right, you will not regret doing this. I think that you'll be glad. I think time will tell that with the stock market and with all that, you'll be glad you're in something that's a little more solid and secure as the base. I do like to call this the base of my portfolio, and that's where I invest from. And that's I like to say that a lot. Is sometimes it's number one, knowing where to invest from. Maybe I do still have self-directed IRA that I'll do deals that incur tax,
Oh, this
that's
is it?
okay to incur taxes on. So, so anyway, that's what, that's kind of how I use it. I don't have anything in the stock market. I can tell you, I do have self-directed IRAs that have real estate investments in them. So, all right. Anything else? Let's shut it down then. Thank you guys. Thanks everybody for being on here. Again, I hope you got some value, and connect with me on LinkedIn if we're not already. Y'all take care.